Okay, so what's the definition of a sole proprietorship? Sole proprietorship is really just a business where there is no separation between the owner and the business itself. And that means that all the profits that someone might make as a sole proprietor go directly to their personal profits, and there's no filter in between. It also means all the liabilities, all the hazards that a sole proprietor might encounter, lawsuits, things like that, will also encompass their personal assets. This is why some people will form a corporation, and that could be an LLC, it could be an S Corp, a C Corp. There's a number of different formations, and the reason someone would form a corporation rather than be a sole proprietor is to put the corporation as the business entity. Then any liabilities or lawsuits, things like that, that would be encountered, would only be able to attach themselves to the assets of the corporation. So that means that your personal property, your house, your car, so forth, those things would not be subject to the suit that was being had. So many times you'll see people forming LLCs. They'll form partnerships, they'll form all sorts of different variations of corporations, really to protect themselves from the liability that might be encountered when they're in the course of doing their business. The other thing, though, is that if you're a corporation, you're going to receive income as a corporation, and then that will be taxed. And then you'll also pay yourself a salary as an employee of the corporation. So that's something that a sole proprietor doesn't have to worry about. Any income that comes into a sole proprietorship goes straight to that individual. It's taxed once at your normal income tax rate, and you're satisfied. So that is what a sole proprietorship has as both its advantages and disadvantages with a corporation.